And today, that war in Iran is a factor that we haven't really seen anything similar in my lifetime, although we have had previous Gulf wars. I think the other thing that's a little bit different today is the fact that we're about to get a new Fed chair, and we don't know exactly, what his point of view will be with perhaps a bias toward trying to reduce the Fed funds rate, short-term rates, but with inflation still above 2%, really closer to 3% today, there's not too much I think the Fed could or should do in lowering rates near term. So I wouldn't be surprised if the market just treads water for a while now. Earnings seem to be pretty good. That's always a key factor as well. I think one thing that I've hopefully learned in my career is to try to remove the emotion from the investment decision. In the final analysis, corporate stock prices are a function of earnings and earnings growth, and then whatever PE multiple you put on those earnings. As I mentioned earlier, earnings have been coming through pretty solid. That could change if the war in Iran lasts longer than most people expect, and if oil prices go from the current $100 per barrel range up to 120, 130, 140. We could possibly be facing a recession, not just in this country, but in a lot of the G7 and other countries that we trade with. So that's a wild card. And to me, another lesson I hopefully have learned in my long career is the importance of being diversified, not putting too many eggs in one basket. And so whether you're talking about stocks, where I think it's important to have a non-US allocation as well as your US allocation, but also within the US, have your large cap, your mid cap and small cap, but also have a good style balance between growth and value. And when you see one area of the market significantly outdoing the other, I think a good discipline is to trim back your winners. In this case, mega cap growth names have really dominated the U.S. market for most of the last 5 or 6 years. And so I just think it's prudent to trim and take some of those gains and rebalance into small, mid-cap, value-oriented names. My comments apply more to institutional investors where you don't have to pay a tax on capital gains. When you're thinking about retail or individual investors where you do have to pay a tax and then you're reinvesting 75 cents on the dollar, that can be a different issue because you have to be even more convinced that whatever you're trimming is not likely to continue to do so well, outperforming the rest of the market. And whatever you reallocate those funds into is likely to do better. So it's really a twofold decision when you make that kind of rebalance as a retail or individual investor.
Yeah, that's a great breakdown. People tend to forget about taxes when they're investing or even when they're preparing for retirement. They'll have a lot of their money in pre-tax accounts, and they'll retire and they'll pay Uncle Sam. They'll take out $100,000 to give Uncle Sam 40,000 of it or something. They're really upset of it when Uncle Sam's really happy that you just retired. So you were mentioning your strategy, a good approach with the diversification, and you actually were mentioning the barbell strategy, whereas if you see growth start to get too heavy, maybe you move a little bit heavier to value inside of your investment strategy. Inside of that, you mentioned that you were referring to institutional investors. That's the level you worked at before. Can you go a little bit deeper into that as to like some of the differences because people always see institutional investors as having the advantage, but there's a lot of information now for retail investors